right, welcome back to Iron Financial. Today, we're cracking open Seagate Technology's latest earnings report. Now, they've just posted some absolutely massive numbers, but the real question we have to ask is this. Is this just a temporary surge, something fueled by all the AI hype, or are we looking at the start of a legitimate long-term growth story? We are here to cut through the noise, to figure out if this company is truly built on a foundation of steel, or if there are cracks hiding just beneath the surface. Let's get right into the raw data.
And this quote right here from the CEO, Dave Mosley, it really sets the entire stage perfectly. He's not just talking about selling more hard drives. No, what he's doing is positioning the entire company as the essential, the load-bearing infrastructure for the whole AI economy. He's making a very, very clear statement. He's saying, you can't build these massive AI models, you can't run these cloud empires without our technology. That is a bold claim.
It's an incredibly bold claim, and let's be real, it's the absolute core of the bull case for this stock, right? But honestly, amplifying the creation and economic value of data, that's just a really fancy way of saying that AI is generating an absolute ocean of information, and it needs a place to put it all. Seagate wants to be the one selling the buckets. But the real question for us, the one that really matters, is this. Is the bucket business actually profitable right now?
Oh, it is a very profitable business. In fact, calling it profitable is a massive understatement. This wasn't just a good quarter for Seagate. This was a quarter that completely rewrote their own record books. So let's take a closer look at the headline numbers because this is where we really begin to stress test the foundation of this company.
So the very first number you have to look at is the top line, revenue. They pulled in $2.83 billion. Now that is a massive figure. And it didn't just meet expectations, it completely blew past the high end of their own guidance. In a market this volatile, a beat is one thing, but a beat of this magnitude, that signals some powerful underlying momentum. Okay, $2.83 billion is a big number, I'll give you that. But what's the growth rate? Is this just some one-time spike from a few big orders, or is this part of a sustained upward trend? We need to see how this stacks up against last year to really understand the trajectory. A single number, by itself, tells us almost nothing.
And here is that exact context. As you can see right here on this table, that top-line revenue number is up a full 22% year over year. Now, for a company of this scale, in what a lot of people consider a mature industry, that is a huge leap. It's a powerful signal of accelerating demand.
22% is definitely impressive, no doubt about it. But my eyes go straight to that next line, gross margin. It's up by nearly 7 full percentage points to over 42%. I mean, that is a massive expansion. How exactly did they manage that? Where is all that extra profit coming from?
That's a great question, and really, it's the key to this entire story. That margin expansion is a crystal clear sign that they have significant pricing power. It means they're not just selling more hardware, they're selling it for more profit on every single unit. They are commanding a premium in the market.
Yeah, but is that sustainable? That's what I want to know. Is this some kind of temporary advantage because of a supply crunch? Or is it a structural change in their business? Because let's be honest, margins like that can compress just as fast as they expand if the competition decides to get aggressive.
We'll get to the how in just a moment because it's tied directly to their technology. But before we move on, don't overlook that last line, the bottom line. Non-GAAP diluted earnings per share is up 53%. 53! That's not just growth, that's explosive profitability. They are converting that revenue and that margin strength into pure hard cash for their shareholders.
And to put a final heavy point on it, this slide really says it all. These aren't just good numbers compared to last year or compared to Wall Street's expectations. These are all-time company records. Highest gross margin ever, highest operating margin ever, highest non-GAAP EPS ever. So when a veteran company like this starts setting all-time personal bests across the board, you have to stop and ask what has fundamentally changed in their business model.
Okay, I'll concede setting multiple company records in a single quarter is a major, major signal. You can't just ignore that. But it also sets an incredibly high bar for the future, doesn't it? The market is now going to expect this level of performance every single quarter. I mean, are they at risk of becoming a victim of their own success here? We need to look at the underlying drivers to see if this performance is truly built to last.
Exactly. So, how did they pull this off? Was it a stroke of luck, a one-time surge in demand, or is there something more structural happening here? Let's get into the engine room and see what's really powering this performance.
And here it is, laid out plain and simple. Almost 80 cents of every single dollar Seagate made came from one place, the data center market. I mean, that is a massive concentration. It makes them a pure play bet on the growth of cloud computing and AI infrastructure. There's very, very little diversification going on here.
You're right, it is a huge concentration. But in this market, I'd actually argue it's a smart focus. They have deliberately aligned their entire strategy around the single biggest growth engine in the entire tech world. That other 21% from Edge and IoT. That's fine, it's stable, but the data center, that's what's doing all the heavy lifting. This chart tells you that if you believe in the future of the cloud, then you have to believe in the future of Seagate.
And the growth in that one segment is just immense. They did $2.2 billion in a single quarter from data centers alone. That is a 28% jump from the same quarter last year. This is the core of their record-breaking performance. The demand from their global cloud customers is absolutely relentless, and it's all being driven by the insatiable data needs of artificial intelligence.
A 28% growth rate on your largest segment, that is the definition of a powerful tailwind. But let's be specific about who these global cloud customers really are. We're talking about the hyperscalers, Amazon, Google, Microsoft. These are notoriously tough, sophisticated customers who can squeeze their suppliers on price and will switch to a competitor on a dime if they can get a better deal. That record high margin you were so excited about earlier, well, it seems extremely vulnerable if these giants decide to play hardball.
And that's a valid concern, and normally you'd be absolutely right. But the sheer scale of demand right now is so massive that it actually shifts the power dynamic. To really wrap your head around that scale, we need to understand this term, the exabyte. It's a ridiculously large number, 1 billion gigabytes. To put that into perspective for you, all the data created in the entire world back in 1999 was about 1.5 exabytes. It's the currency of the data center world.
So in this one quarter alone, Seagate shipped 190 exabytes of hard drive capacity. That is up 26% from the previous year. Just think about that for a second. They are shipping over 100 times the amount of data the entire world created in 1999 every 3 months. This isn't about selling a few more drives to small businesses. No, this is about equipping the fundamental digital infrastructure of the entire planet. 190 exabytes. It's an astronomical number, I get it, and that kind of volume gives them enormous leverage in negotiations. But volume alone isn't enough to build a durable business. They need a technology advantage. What's their moat? What are they actually putting in the box that makes them the preferred supplier and allows them to command those high margins you were talking about? How are they staying ahead of the competition?
And that brings us to the real secret weapon, the technology. It's all about their new Mozaic platform, which is built on something called HAMR technology. The earnings report explicitly calls this out as a key performance driver. This is the product that's enabling those record margins. This is their moat.
Okay, HAM. Heat-Assisted Magnetic Recording. The name sounds pretty complex. Is this a real defensible technology advantage, or is this just some clever marketing jargon they've cooked up? No, it's the moat. Think of a hard drive platter as a massive library. For years, companies have been trying to write with smaller and smaller letters to fit more words on each page. HAMR is like having a microscopic pen guided by a laser that lets you write with incredible precision so you can fit an entire encyclopedia on a single page. For data centers, this is a complete game changer. It means massively more storage in the exact same physical footprint, which dramatically lowers their total cost of ownership, things like real estate, power, and cooling. That is a value proposition they will pay a premium for, and that's what is fueling Seagate's margins right now.
And just look at the execution here. This isn't some science project stuck in a lab. Their current Mozaic 3 Plus drives are already fully qualified and are being shipped in high volume to all the major US cloud players you just mentioned. They're already working on the next generation, Mozaic 4 Plus, with qualifications happening as we speak. The technology is proven, it's working in the real world, and they have a clear roadmap for even greater density in the future. Like the 7 terabytes per disk they've already demonstrated internally. This is a multi-year technology lead over their competitors.
A technology lead is only as good as its lifespan. Competitors are not standing still. And what about the threat of disruption from entirely new technologies? Like DNA storage or something else we haven't even heard of. Still, for now, I'll admit, having your flagship product fully qualified and shipping to the biggest customers on the planet is a huge de-risking event. But a company can have the best tech in the world and still be a terrible investment if the balance sheet is a complete mess. So what does the financial foundation actually look like?
That's the perfect question. Because a great quarter is one thing, but a great investment requires durability. So with all this success, is Seagate building a house of cards on a temporary trend, or are they constructing a fortress? Let's take a hard look at their financial foundation and find out.
Take a look at this chart. A year ago, they were carrying nearly $5.7 billion in total debt. Today, that number is down to $4.5 billion. They have paid down over $1 billion of debt in just 12 months. That is aggressive and incredibly responsible capital management. Every single dollar of debt they eliminate reduces risk, it lowers their interest expense, and it gives them more flexibility for the future.
Shedding $1 billion in debt is definitely a good look. It shows discipline. But where did that cash come from? Is it from selling off assets or some other one-time event? Or is this cash being generated by the core business itself?
Well, they were very specific about it, and it came directly from the core business. This quarter, they targeted $500 million in a specific type of debt called exchangeable senior notes. Now, just think of that as a loan that has an option to be converted into company stock later on. By paying it off now with cash, they're simplifying their capital structure and, very importantly, reducing the risk of future dilution for existing shareholders. It's a very deliberate, very strategic move.
Okay, so they're being smart about paying down the debt, but what about cash generation? Because if their cash flow is weak, they won't be able to keep investing in new technologies, like the next generation of HAMR, or return capital to shareholders. So how much actual, usable cash did the business spit out this quarter? This right here, this is the number that should really grab your attention. $607 million in free cash flow in one quarter. And to be clear, that's the cash left over after all operating expenses and after all capital expenditures for factories and equipment. It's pure, discretionary cash that the company can use for whatever it wants, more debt reduction, dividends, or reinvesting in R&D.
And to add some crucial context here, that $607 million isn't just a good number. It is the highest level of free cash flow the company has generated in a single quarter in 8 years. 8 years! This tells you the operational efficiency and the core profitability of the business are at a level not seen for nearly a decade. This is a cash-generating machine running in absolute high gear.
An 8-year high in free cash flow, that's a powerful statement. It's really hard to argue with that. It shows the earnings aren't just paper profits. They're real, spendable cash. So, okay, the past was great, the present is strong, but what about the future? What could derail this story? A slowdown in the AI market? A new competitor suddenly emerging with a breakthrough? What are they telling us to expect next?
Right. The market is always forward-looking. So with all this momentum at their back, what's next for Seagate? Are they expecting the good times to keep rolling, or are they signaling a slowdown? Let's take a look at their guidance and their capital return policy to find out. This is where management really puts their money where their mouth is.
Just look at their guidance for the next quarter, Q3. After posting a record-breaking $2.83 billion, they are guiding for $2.90 billion at the midpoint. They are explicitly telling the market this wasn't a fluke. The strength is continuing. They are projecting sequential growth on top of a record quarter. That is a signal of extreme confidence in their business pipeline and their order book.
Well, guiding up is always better than guiding down, that's for sure. It shows the momentum is intact for at least the next 3 months. But I'm always a little wary of guidance. It's a projection, not a promise. Still, it does set a positive tone. So with all that cash they're generating and expecting to generate, what's the plan for shareholder returns? Are we talking dividends, buybacks, or both?
Right now, the focus is a consistent dividend. They declared another quarterly cash dividend of 74 cents per share. Now, this is a critical piece of the puzzle. They are generating record cash flow, they've paid down over $1 billion in debt in a single year, they are investing in next-gen R&D, and they are still returning a significant amount of cash directly to shareholders every single quarter. This is the hallmark of a mature, healthy, and shareholder-friendly company. They are balancing growth, financial stability, and investor returns. That's the trifecta you look for.
Okay, I have to admit, the picture is strong. Record revenue, record margins, a clear technology lead with HAMR, an 8-year high in free cash flow, aggressive debt reduction, and a solid dividend. The foundation looks very, very solid right now. They've checked all the boxes. So what's the big picture risk here? What could derail this whole story? A new technology that makes hard drives obsolete? A sudden slowdown in the AI market? What's the final question we should be asking ourselves?
And this is the question that really frames the entire long-term investment thesis. We are in an era where the amount of data being created is just exploding exponentially, doubling every few years, largely thanks to AI. Seagate, with technologies like HAMR, is leading the race to store all of that data. Today, they are keeping pace, and they're profiting handsomely from it.
So, the verdict? Opportunity or trap?
Based on this data, Seagate looks like a clear opportunity. They've built a financial fortress on the back of a powerful technology advantage, right in the middle of the biggest tech trend of our lifetime.
I agree, but I would add a critical word of caution here. The tech industry is littered with the corpses of companies that had a lead and then lost it. Seagate's execution is flawless right now, but the challenge for them, and the ultimate risk for investors, is maintaining that lead in a race that never, ever stops.